Alright everyone, Cowboy Trades here, welcome back to the channel. So I just wanted to give you a super quick update on one of the leading market indicators that we do like to look at on this channel. This is of course the iShares TIP ETF. Now if you're a veteran you'll know exactly what this is. About 7 days ago we talked about this over here and talked about how when this does break down to the downside this is going to cause the markets to nuke back down. We talked about how these treasury inflationary protected securities, basically bonds that are protected against inflation, are going to move down once the interest rates push up to the upside, because while they are protected against inflation, if the interest rates are raised high enough to combat that inflation, then they can become unprofitable. And this is exactly what's happened. We've marked basically over on this chart, the iShares TIP ETF, these green vertical lines every single time the interest rates are raised. And you can see, you know, it doesn't always 100% correlate to the exact top, but you can see break to the downside. We continue to roll back down to the downside. This almost marked the exact top. We rolled back down to the downside. This marked the top. We rolled to the downside. Marked the top. We rolled to the downside. And as you can see, since the new CPI, or not the new CPI numbers rather, since the new interest rate numbers have come out, this has caused the iShares TIP ETF to cascade back into this bear flag that we've been residing. Now, we talked about what this is going to do for the markets in our previous video, and we also talked about the similarities between this failed move equals a fast move in the opposite direction that we saw in July of 2022. So, you know, why do we particularly care that the iShares TIP ETF is breaking to the downside? Well, this is how we called for new stock market lows to happen around about September. Like I said at the start of the video, the iShares TIP ETF is a leading indicator for the rest of the markets. If these bonds, which are protected against inflation, start losing profitability, then you can imagine the ones that aren't are going to become even more unprofitable in the first place. And as you can see, the iShares TIP ETF broke to the downside on the 1st of September, and this is what happened in the stock market. The stock market had a bounce to the upside while the iShares TIP ETF was breaking to the downside, and we told you this divergence right here is not going to last very long, and we are soon going to snap back down to the downside because the iShares TIP ETF, basically the rest of the markets will follow this, especially your S&P 500s, your Nasdaqs, etc. So iShares TIP ETF broke down into new lows after this failed move equals a fast move in the opposite direction on this bear flag, also after the interest rates were raised, which is exactly what is happening right now. This is almost an exact copy of what happened back over here. A few dissimilarities, but it is more similar than not. So just wanted to give you a quick update. The last time this happened, the iShares TIP ETF broke down into new lows. The stock market had a failed dead cat bounce, and then we obviously broke back down into new lows in September. So what do I think is going to happen? I believe the iShares TIP ETF is going to continue breaking down. I believe that we're going to fall into new lows, and this will of course drag the S&P 500 down with it. Now, just quickly wrapping up this video, if we look at some of our on-chain metrics, not the on-chain metrics, sorry, the oscillators, you can see the squeeze momentum indicator is technically still in bullish territory, but heading down to neutral after this most recent scam pump failed move equals a fast move in the opposite direction, whatever you really want to call it. And, you know, I'm not drawing this as a trend line, I'm drawing this as a line of best fit. You can definitely see there is a linear downtrend in the amount of momentum that we have in bullish swings to the upside, and you can also see the same on the opposite side. When we are having these bearish swings back down to the downside on our squeeze momentum indicator, they're becoming more and more brutal. I mean, you know, this was a pretty nasty downtrend as well, but when the squeeze momentum indicator started rushing down here, it absolutely nuked the markets back down with it. So squeeze momentum indicator is saying we're sitting in neutral, and we should be getting ready to have a huge nasty flip down to the downside, creating new lows for the iShares TIP ETF, making new lows for those treasury inflationary protected securities, and then of course with new lows in the tips, you are going to see the S&P 500 follow to the downside. Now, in terms of liquidity conditions as well, if we do look at the MFI, once again, just drawing a line of best fit, you can definitely see there is a very linear downtrend that is playing out at this moment in time. MFI is sitting at 55, which is relatively overextended considering that we are in a bear market and we've reverted back to the mean price. Now, liquidity conditions across the board are also starting to come down. We talked about this recently in my most S&P 500 video, and we told you, look at the mid price, look at the book depth in the S&P 500. This is going to start moving to the downside very, very soon, because there's no way markets can continue residing in this extremely overextended liquidity conditions while we're having financial conditions the way they are. So liquidity conditions are still very overextended, and in my opinion they've got a long way to go down until they make new lows in terms of the contract quantity sizes. So all in all, iShares TIP ETF is getting ready to break down to new lows in my opinion, and this will drag the S&P 500 down with it. Now, just one other chart that I did want to wrap up on. If we do look at the IEF LQD ratio, which basically tells us what's happening with financial conditions, I've got a key over to the left here. When the IEF LQD ratio moves to the upside, it's a sign that financial conditions are tightening. Why is it tightening? We've just raised interest rates across the board. And also, I'm going to make a separate video about this, but government bonds and the yield spread is rushing to the upside right now. So financial conditions are tightening. And of course, when we're in these tight financial conditions, it is not good for the S&P 500. It's not good for your cryptocurrency markets, and in general, it's not good for any markets apart from the DXY and government bonds, which of course, those go up, the rest of your markets will come down to the downside. So financial conditions are starting to tighten as liquidity conditions top out, and also iShares TIP ETF, enough said, leading indicator, if this breaks down into new lows, the S&P 500 is going to be boned, in my opinion. That's all I've got for you for this video, my friends. As always, if you do enjoy the content, make sure to let me know down below by leaving a like and a comment. Share the videos with your friends. It's been your boy Cowboy Trades. I'm out. Peace.